Hey, good morning, guys. Let me get this screen share going. I want to welcome you to the Q&A session for swing trading with my goon buddies at Ablewaytech. Thank you for organizing me.
Thank you for hosting this.
Yeah. Yeah, we'll see. Well, let's see how it goes before you thank me. Let's never really know. Yeah, so these are the questions that were sent in that I'm going to address. But first, Alex had asked me, is there anything I could say about AI and all and improving our trading process? So I just got done making a 90-minute guest lecture at University of St. Mary's doctoral program on incorporating AI into our professional practice. I've been working on the innovations group at Army University to do exactly that for improving our not only educational practice with our military leaders, but also looking at their executive function. In other words, how to use artificial intelligence to train our decision making under uncertainty. And the reason I say that is because the model that I use for professional performance for traders is the same one that I use for Army leaders, and that is the plan, prepare, execute, assess framework. And the point that I made to St. Mary's and which I make to Army University is that artificial intelligence is very much like um, alcohol, money, and fame, in that it will make you more of whatever you are, or it will reveal the true you. And so there are three use cases for artificial intelligence, and I can say more about that, and I will provide the 90-minute recording of the lecture. But what I want to say about AI up front is there's three use cases for artificial intelligence inside of your professional practice. Use case number one is where you ask it to do something routine and well-known and uh, simple, like add this column of numbers, and it does that, so you don't have to. So you should do that. The third case, use case three, is when you believe that the AI is just smarter than you, so you just ask it what to do and then you just do it. Okay, so that's dumb. Um, the problem with use case three is that AI is already so good in so many ways that you can get lulled into a sense of confidence where it will hallucinate when you're least expected. So use case three is dangerous, and it's only going to get more dangerous as AI gets better. The example that I like to use on that is, imagine I had a system, an AI system, that gave me a good idea 9 times out of 10. Well, I would always be looking for that 1 out of 10 hallucination because that could kill me. But what if I had invested a lot of time and money in back testing and forward testing and training so that it gave me a correct answer 99.9% of the time? So 999 times out of 1,000, it was correct. I could be tempted to just do whatever it tells me and not worry about that 0.1%. If I did that, and if I were successful, and I started to add more and more risk capital to that decision, then when it finally does hallucinate, I'm at my maximum position size and I take the greatest loss I ever took. And as Ed Thorpe says, if there's ever a mathematical possibility, a non-zero chance of you going bankrupt and you still take that chance, then it's not a matter of if, it is simply a matter of when that's going to happen. So use case 3 is dangerous. And when the AI is not very good, it's obvious why you don't just blindly accept what it does. But the hidden danger on that is as it gets better, and remember, AI is only going to get better each and every day from now on until infinity. It's only going to get better. So each day it's going to become a little easier to trust in it a little bit more. And that's the hidden danger long term of use case 3. So use case 2, which is the Goldilocks use case, the Goldilocks solution, is not too hot, not too cold. It's just right. So what we're looking for in use case 2 is the blended performance of the human AI team, where the human is a subject matter expert to some degree and exercises final judgment, human in the loop, and is constantly on an aggressive lookout for hallucination. Because hallucination for AI is the same as creativity in humans. It comes from unexpected locations. It's usually bad. Sometimes it'll kill you, but once in a great while, if you're lucky, it could be a big payoff. So when the AI hallucinates, the conventional wisdom is, oh, the market's broken, I need to go somewhere else. No, the correct response is, I wonder if the hallucination this time is a positive mutation. Let me rapidly assess it because it started from a place of grounded excellence and then made a connection. And with our wisdom and judgment, we determined it was off track or it had drifted and it's out of tolerance. And so it's a hallucination instead of an extension. But it started from the same place in an unusual way. And I can't know a priori if there's any second and third order effects, if that's any good. So I treat a hallucination as a special compound critical state in which I can judge to see if that is enough to change my mind and consider new things that it saw that I didn't see. So I always treat a hallucination as a secondary research question, a new avenue to explore. And I don't prematurely say, no, that's not. I know that it doesn't fit exactly what I was looking at right now, but it may be something that I need to add. I've actually had several experiences where the hallucination of the AI revealed entirely new areas to explore that I had not considered, and I had to reframe and reshift and reset. And that has been responsible for several really important expansions of my mind and my perspective. But 999 times out of 1,000, that's not the case. It was just a hallucination. You know, sometimes a cigar is just a cigar, but sometimes it's a smoke, as Churchill might have said. So use case 2 then requires a human in the loop. And so I conclude this introductory remarks by saying that the single most important thing that you can do to remain relevant and productive and a strong member of the human AI team is to cultivate a research perspective, the research perspective of a research supervisor. Now, I've been the doctoral dissertation chair for about 25 doctoral dissertations and almost 200 master's theses. And I've learned some things about being a research supervisor. So when I'm a research supervisor, my job is to make sure that the student has refined their research question to the best possible point of view to get an answer to something that's really powerful and useful, important, and helpful. And then to identify the secondary research questions that allow us to understand the primary question and that we have to learn along the way in order to get a good answer. And I have to make sure that the research method that we choose is appropriate for that kind of question and that the evidence that we gather is representative of the population in the world, so it's a good sample, and that we apply the assessment correctly, and that we interpret the results to the limit of the power of the statistic to give us insight, but not beyond the region of fit. And I have to remember that we can make type 1 and type 2 errors when we're performing statistics, which is when the sample gives you an abnormal view of the population, that there's something beyond the region of fit. So there's, no matter how good the evidence is, we always remember that it's a sample, that the world is a large and mysterious place. And that's important to remember when we're going to bring artificial intelligence and a statistical point of view to try to understand markets better, because markets are non-normally distributed. They are not a series of independent events. There is various degrees of information available to different market participants, and it's an open dynamic system. So, in the same way that I would say be careful, but proactive and professional in the use of artificial intelligence, it's because I also believe the same thing about statistics. Be careful, be proactive, be professional, and try to be profound in the sense that you always are mindful of the vastness of the universe and its mysteriousness, and that all you're ever doing is taking a sample of a system that is becoming something different than it was in the past. So even if you had the complete market information available to you, all you can study is what has happened. And if you believe it's an open adaptive system and you cannot predict with certainty what it's going to be because it's too large, then you have to have a certain grain of salt in how you reason about the future, whether you're using statistics or a special case of it, AI with machine learning. So that may be the most important thing that I say today with a view towards the future. Uh, and I hope to show that in the answers to the questions that you've given me, that I have incorporated that certain sense of both art and science in the discussions ahead. So um, my intention is to give you, as a result of coming to this session, I wrote about a 90-page reference manual for our doctoral students and my military officers who are assisting me as research supervisors, to teach them how to be research supervisors. Because my job is to prevent the passionate, industrious, never tiring research student, to keep them from going off the deep end. And so when we're dealing with AI, you want to have exactly that same kind of mentality to make sure that you're alert if it's going off the deep end. So the 90-page booklet is a set of instructions on how to be a good research supervisor, which incorporates critical thinking, creativity, systems thinking, statistics, self-awareness, uh, professional thinking, and it breaks the research process into 15 critical tasks and what you should be doing in each one of those phases so that you can ask good questions of the AI. It's really how to improve your executive function, how to be a better chief decision maker, how to be a generalist in a world dominated by specialists. And that's exactly the role that humans need to play with respect to specialized artificial intelligence. The seductive lure will always be to defer to the AI because they'll show you how well trained it is. If you ever relinquish responsibility and authority for the final decision, then you're just using use case 3, and you just hope that this isn't the time that the AI is going to hallucinate and destroy the world or your small part of it. So that's the short answer to the AI question, Alex. I think it's a great question. My intention is to give you the 90-page booklet on how to be a research supervisor. It will strengthen you in the world, but it will also help you with how to evaluate trading systems and back testing and forward testing, and really how to evaluate your own performance as you go forward by treating it as a research project. And it will strengthen your ability to self-coach and to be a helpful coach to others. So you'll get that 90-page booklet, and I'll also give you the 90-minute lecture that I gave at University of St. Mary's, which I wrote that book for. I wrote the little 90-page booklet for that briefing and for my uh, fellow faculty for the Army College that I teach at, because I think it's that important. And I made that same point that I just made about how to use case two correctly for AI and statistics. Only it took me 90 minutes to do it that time. I gave you the executive summary here, and I like the way it sounded. Okay. Did that sort of,
Much appreciated.
okay. And for the record, what I use is Claude 3.5 Sonnet as my default large language model of choice. It's the best rated public large language model. And it has an ethics and security module built into it, which some of the other ones don't have, and I like it for that reason. Okay. I want to go through those 9 questions there, and we'll see how good I do on this, right? So how do I trade the swing trade or critical state templates using the Kata challenge technique? So just to level the playing field, the Kata challenge simply says that what I want to do is have a symbol that's ready to trade. So I've got some symbol that's ready to trade, and I put a trade frame on it so I know where I'm supposed to get long and where I'm supposed to get short if I am going to stop and reverse, and the size of my risk box. And then I have some standard framing which gives me a reasonable target to the upside, which says for 1 unit of risk, I have at least 2, preferably 3 units of reasonable reward. So if that's my standard trade frame, I'm going to say for the Kata 2 challenge, any swing trade pattern, mechanical, or any critical state template that comes out of the sniper, and this would be any swing that's in the edge raider, that those 2 things are creating the symbol and pattern ready to trade. And then we prove that with the trade frame because it meets all the criteria and we have 2 to 1. So now what I want to do is what I've done is I've done the plan and prepare. What you're really asking me is how do I trade that using the Kata challenge technique? I'm really going to now talk about how do I execute. So the idea behind the Kata challenge is that we start with the level 1 of that, if you will, is that the market opens, and then we want to see something that is in play, meaning that it has moved intraday 1.5 frog boxes, or it's moved a non-controversial directional move away from the open. So that's larger than a normal noise move. It's if that's what the normal noise might be, details later. It's moved beyond that, so there's no doubt that this thing is in play. Typically, I look for the downside move, and we would call that a harsh winter, meaning that the MACD histogram has moved below the 0 line and is deeply into the winter, and it's clear that this is an abnormally large negative move. And then what we're looking for is a turning point, that instead of continuing on further, this thing has decided to move 1 risk box off the low and is now potentially going this way. So we would call that a SSC setup, supported spring crossing. Now, when that works, it can work forever. It can be great. When it fails, we know that it fails if the initial risk limit that we put here below the low of the day. So if it reversed and I got long here, and that creates my risk box, we know that that SSC fails if it goes through the original stop. I now have information that this thing is continuing to fail in the same direction that it just had an abnormally large move. And because it has not yet moved to a range stat, which we would call the maximum reasonable intraday move, I know that there's enough move to get the second leg down. And so the failure of an SSC is a collapsing dragon. But if this thing is against all odds successful and it allowed me to have a successful SSC, which exited here because of a rule, and now instead of it coming all the way back and failing, it now is going to reverse and go higher again. Now what I have is a set of a low and a higher low plus a successful trade. Before it breaks out above the peak of the RL10, I have the ability to enter inside this region, which we call the Kata 2. It's a buy strength on a dip with a measured move, and I have a 2-to-1 to the upside. Now, this little pattern that I've just showed you is standard intraday trading. It's also fractal in the sense that after any harsh sell-off that has now reversed, I come into a region in which I can either take the SSC and, if successful, a series of Kata 2s, which is just re-entering after a successful trade. Each one of these little buy-on dips is a Kata 2. And I'm going to apply the same standard rule that I did to the first Kata 2. And that was, I have a series of higher lows. I still have room to a reasonable target to get my 2-to-1. My risk reward box is well defined, which means my reward box allows me to say 2-to-1. And the Kata challenge is, can I continue to execute a simple entry and re-entry technique, provided that the trade frame is still valid? Or upon failure, can I take the collapsing dragon because I've recognized the initial harsh sell-off? So the Kata challenge is really a chance to do execution phase of well-established patterns that I got in plan and prepare. I've picked symbols that are ideal to trade because of the possibility of a large move in either direction. I've seen the screening criteria of a uncontroversial directional move, and I have a setup where I am in a compound critical state intraday, and I can trade either the SSC or the Kata 2 challenge in a standard way. So regardless of the particular swing trade pattern or sniper trade that gave me the setup, I'm going to execute all of these in a standard way so that my execution is a battle drill. I can plan for a variety of reasons to be interested, but when I'm interested and it's working, I want to trade it in a standard, simplified way according to the rules of the kata. And it's going to come back later and say, do all swing systems share a common exit strategy? I'm just going to answer that now and say, yes, that I have multiple reasons to get into a swing trade. But once I'm in the swing trade and I'm executing the trade management, which leads to finally an exit, I'm going to do all of that in one way, many reasons to get in, one way to manage, one way to exit. Then when I make and I study improvements to my exit strategy, which is an improvement to my management strategy, it's going to affect all of my entry systems. So by concentrating on improving my execution and exit strategy, I'm raising the bar on every single strategy that I have, whether it's a swing trade, a hybrid swing, or an intraday pattern. And that's my logic. The logic behind that goes something like this: that on a trade that looks like this, I bought on a dip or something, I might end up making 10 decisions on how to raise my stop in response to locking in gains. I made one decision to enter based on reward to risk and the potential for a good target. And I might make 9 adjustments to raise my stop according to rules to lock in gains. And then on one of those, it failed to follow through and it just decided to take me out. So I don't even have to make an active decision to exit. I already made that decision in how I managed the exit, and then it surprised me into the exit. So what that really means is, on a really successful trade, I made one decision on how to enter, and I made 9 decisions on how to improve my exit. So I want to spend most of my time on the 90% of the decisions that I make that allow me to lock in gains. Each one of those decisions to adjust my stop is a adapted reward to risk ratio decision, that as I start moving up the stack and I'm locking in more and more gains, the target that is reasonable is getting closer and closer. And if I get to that level and it starts to fail, I've already realized 100% of the gains that I hoped that I could get. So the reasons that I have a common exit strategy for swing and a common exit and reentry strategy for the Kata challenge is that I want to execute according to a very simplified battle drill. I want to have planning and preparation to frame a lot of different ways to be interested in symbols that are ready to make big moves. But once they start making big moves, I want to standardize and simplify my battle drill. And that's exactly what the Kata challenge does. So, how do I trade the swing trade or snipers? I execute according to the Kata challenge techniques, and I focus on exit management and follow through. And then all I'm going to do is simply assess how that went, and then I can accumulate a lot of data from a lot of trade frames on how that standardized exit. Now I have data that I can use to decide how to make a decision to adjust or modify my exit strategy. Check or hold. By which I mean, any questions on that? Fair enough? All right, hearing nothing adverse, I'm gonna move on. I should probably open up the chat window so I can see if you there we go. Okay. Yeah, Taleb's turkey problem, as Griff points out. Yep, exactly right. All right, so yeah, I look for range and travel time. How do I evaluate travel time effectively, and how do I do this? Really comes down to the idea of the trade template. I think of it this way. Um, so I had some kind of prep time, planning and prep, and I had some little risk box. And if if it if that's my standard risk, and I get a decision to enter here, and this purple line at the top is going to reflect my reasonable, well, it should be purple, sorry. This purple line reflects my ideal target, my reasonable target. And now you can see that wow, this is great. I've got 4R potential on that particular one. We might say that if I studied that pattern over time and I saw, especially for swing trading, if the average swing trade that is successful costs 5 days, So maybe I have 1, 2, 3, 4, 5 days. And if my average win is the average target, then the perfectly rational line would look like that. That's 100% efficient and smooth. I would be happy to get that trade. And then anything that got to my target faster than the average time would be better. So I might say, if I could get up to here in 1 day, that would be an A trade. And then if it took 2 or 3 days, that might be a B trade. And if it gave me the average trade, it's a C trade. And if after the end of 5 days, it's only gotten halfway up the stack, then maybe that's a D trade. And then if it ever went below my entry, then it's an E trade. And if it ever violated the 1R loss, then that's a F trade. So I like to know this about my standard patterns. When I have accumulated all that data, I can say, how long did we stay in the trade? What was the maximum favorable excursion? What was the point where I exited? How many times did it fail and go the other way? So when I start studying all of those, I can start constructing something that looks like the most normal natural trade of that type. If you wanted to, you could just do the set of all swing trades. You might break that out into something where you said, let me look at 5DDs as a separate thing, and washouts and channeling and overreaction and triple screen and continuation patterns and any of the failure patterns, or you might add any of the sniper patterns in there. So you could either lump them all into a giant swing trade framework, which I have done, or you could break it out by individual patterns so you could see how they are distinguished from their peers, which I've also done. And I've been able to break it out by continuation and failure patterns based on market classification to see, is there a better time to trade failure patterns than others? So I've done all that work. Um, and the idea is that what you care about is duration in the trade from entry to exit, maximum favorable excursion, the actual exit you got, and then you can study that to determine, am I, as this thing is, you're in the trade, you can almost have an expectation that if it should be performing like the average trade is, then you can decide if it's an A, do I want to add a position or am I happy capturing the gain? If I'm in a C trade, I should stay in it because it's at least with the performance, unless I have a better trade working that I can cash this money and then roll that into a better trade so I can trade up. If it's a D trade, I'm going to be very mindful of it. Is it losing steam or is it just slowly gaining? Is it doing like this? Like if it was 5 days into the trade, but the last couple days it's starting to accelerate, I might be willing to stay with it a little bit longer. But if it was just slow and then is just rolling over and sucking, maybe I'm ready to get out of that trade because it doesn't have any short-term advantage to it. So I want to know something about my standard trade template. I can use that to help me inform how I'm going to make standard adjustments to my trailing stop and to improve my exit management. So now you can see the relationship between, is this system good enough to trade? What does the average trade look like? How do I just measure performance over time? And then when should I get out of a trade in order to trade up? Or when should I use maybe market condition or market classification to say, hey, I gave it the 5 days and the market is moving towards bearish, maybe what I need to do is start trimming the underperforming ones and concentrate on just the few that are starting to work. So I need to use that information as part of my nutritious and delicious meta trading strategy, if I can say it that way. Check or hold? All right. This was probably from Griff, a nice softball. Like, What do I think the mission essential elements for a trader is? If I was snarky, I would say, well, to be fair, the 350-page book that Phil and Griffin, my brother, and I wrote, called The Foundations of Trading, had better have all the things that I think are mission essential, or I am a liar. And so I'm striving not to be a liar. Now we may have been more verbose in that than we needed to be in order to get, maybe there's not 350 pages of unique saying said one and one time only. Uh, that's probably true. So what I would say is, as I think about the full range of areas of knowledge, I render it into a one-page flashcard that looks like this, the learning ecosystem. This is version 0.8 that I updated on July of 2019. I haven't changed it in 5 years, so I'm pretty satisfied that this is what I think. I think that this is what I think is mission essential. That's how I would judge myself. And the number one thing, upper left, plan, prepare, execute, and assess, and being ready to trade when the market opens, and then being able to Kata to, and then relentless assessment. So that's the first thing. And if I was going to plan, well, uh, I have to know all of these things about how to do continuous improvement. I have to know these things about my trading systems. I have to have plenty of research references ready to go. I've got to make sure that the reasons why I'm trading, my strategy, are properly resourced for long-term, all-weather, continuous and sustainable trading, and that I have refined my tactical battle drills so that I am ruthless and efficient and effective with my well-trained systems. I got to make sure that I have accounted for all of these different perspectives somewhere in my trading team, whether it's an internal part or it's an external person. I got to make sure that I am using systems thinking and that I'm using a systematic approach to improving my systems systematically. They got to be visual so I can work them off a dashboard. They got to be all weather, all season. I'm going to use principles of Japanese manufacturing to focus on the most important things, to reduce the work in progress so that I can be excellent at them. And I got to bring the rules of craftsmanship in the workplace, the Gemba, so that I can engage in continuous learning and process improvement. I'm going to use the best of Western management to make sure that I am blending both art and science and craft knowledge, which is the Western expression of Japanese manufacturing and craftsmanship. I'm going to make sure that I fully understand how to take my research and my forward testing and learn how to scale that with skin in the game to gather real world data with real live money traded forward, and then make a decision on when to start increasing the amount of skin in the game in order to get production level returns and when to go from limited to full rate production in the way that I scale my different systems. I've got to work on under assessment. I have to have a systematic way to bring each trading day, week, month, and year to closure with an after action review that considers how to do plan, prepare, execute, and assess so that I genuinely and objectively identify my areas of strength that I want to continue, areas of weakness that I need to improve, and how to turn that into smart goals to take effective action using the principles of Kanban to make sure that I am prioritizing my efforts for improvement on the most important things that there are. And to do that, I need the data of marked up case studies and a trade log and to perform all of the statistical analysis so that I can use math to make my decisions, because that is science and craft, and there's certain art and associated, but that's where there is a huge advantage in our style of trading. I've got to then turn all of that math into meaningful values and feelings, and I've got to get periodic performance coaching, and I need to have this documented in my chat room and have accountability partners. And then I'm going to work on being mindful wherever I am and plan, prepare, execute, and assess, that I'm being mindful in how I do that, whether it's strategic, operational, or tactical level. Then when it comes to execution, I need to be able to understand time, will, pattern, and money, how to detect opportunities, decide if I'm going to trade it and with what system, and then deliver the goods, then make the assessment. And I've got to keep in mind my market sector and target trade framing. I've got to be in the zero state when I'm ready to take the shot. And I've got to manage all my trades in a standard way. And then I'm going to document all of my outputs and activities in my 4-column learning journal so that I can get better when I apply all of these principles of continuous learning. Notice how much time I spent talking about the particular rules of any given system, and how much time I spent about all of the other supporting material that it takes to be able to execute a simple system ruthlessly with the idea of standard improvement. That's where I think we have a systematic edge, that we have plenty of simple, robust systems. And our advantage consists of how to do this stuff, and you neglect that stuff at your peril. That's what the book Foundational Trading is all about in with words, and that's what our learning community of practice and courseware is about in practice. So that's what I want to say about what do I think a trader needs to know. I think the Kata challenge technique is so important that I send people to Phil and Griff to learn that before I send them to my foundations course, because I think it's important to be grounded in that before we start taking on some of the calibrated discretionary trading that you get at the higher levels. Check or hold? Well, what do I think is the most common mistakes new traders make and how they can avoid them? So let me show you how I help myself with AI. I said, hey, AI. I wrote a prompt which answered the question based on all of the public teachings that Ken does at Tortoise Capital in his courses. What does he say in his courses are the top 10 problems that traders face, and his recommendation for improvement? Because I think that's what you wanted to know also. I just made that leap. So this is a chance for me to use the AI to see what my actual footprint in the world is. And I reviewed that. And since it's talking about my work, and I never tire of studying myself, this is actually true. The machine did not hallucinate. Lack of a structured trading system. You need a robust trading system and a plan that includes filters and absolutely clear rules. So if I was thinking of the model self, systems, and markets, what I just described here is how the system and the market should overlap, but also how me as the trader is part of that. That's the second one, poor mental state for trading. So I need to know what my optimum mental state for trading is through self-reflection and practice, psychology. Now, that's not just in the state, the zero state when I'm trading, but the larger term psychological aspect of blending all three of these systems, self, and markets, not just when I'm trading, which is in short periods of time, but all in the time and the space between trades. Yeah, there's a zero state psychology that's in play when I'm trading, but there's also all the psychology in between the trades, which is probably more important than the psychology of when I'm in the trade. Because if I've done my rules right, I've limited the amount of discretion that I'm even allowed to apply. That's part of the psychology game, is doing the due diligence to allow you to be hands off as much as possible when you're trading. Over trading or under trading means that I got to have a balance between activity and patience. I got to find the optimal blend of trading and not trading based on our signals. When do I have a favorable advantage? When do I not? And how do I maintain that with some consistency? Knowing that I'm never going to get that perfectly right, but I can approach that. And if I have a rule for how to balance trading and not trading, I can now adjust the rule instead of trusting my gut to make that decision. Failure to adapt to market conditions means that I don't have a robust trading system and plan that takes into account market knowledge. So I need to have that, and I need to have rules to adapt so that I can shift. And then by regularly reviewing and adjusting, I can keep my strategies aligned with the market dynamics. This was a central feature of the morning coaching session with some of my international clients. And what we said was, look, we've got 5 least correlated systems, and each one of them has a different recent pattern of capturing R, independent of money, but capturing points per share. And so, what kind of a market do we have? The actual market classification is the sum, the net of the performances of the 5 uncorrelated systems. The exact market classification for those guys is the results that their systems give. Think about that. Instead of using market classification to decide which system to trade, I'm going to trade them all continuously according to their rules. And then based on how they are capturing R over the last 30, 60, and 90 trades, I'm then going to make a decision on how much money to put on the individual systems as a function of their adaptive performance. And the market classification then is simply acknowledging that how the systems perform is what I care about in order to decide which one to put money on and how much. So instead of starting with market classification generically from a system or a theory of how markets ought to work, I can start with my refined systems, see how they're performing, and then say the market is that kind of a market, and now let me make an asset allocation decision. That's where you want to get to. Which was the chicken and the egg problem here, or the dog and the tail? I actually probably have to start with a generic market classification to make sure that I have systems that are uncorrelated. But once I have the uncorrelated systems, what I need to do is focus on this decision and not trying to change these rules to accommodate my generic first order oversimplified market classification. That's where you need to get to. That's why you collect data on system performances. That's why when you have a robust system, you never stop trading it. You only decide how much money to put on it. It may be so out of alignment with the current market that all you do is paper trade it in a standard way. And then when the R capture performance turns, you now know that instead of being in the winter, that thing is now in the spring of its relative performance. It's moving back towards the market, or more likely, the market is moving back towards its rule sets. Once you understand that, you will never, ever again look at market classification strategies as the end point of your analysis. It is the first step in a long process. And the end state of that is making an informed decision based on current system performance on where to place money at risk. You absolutely have to understand that. Check or hold? Check. Now, next one, implementing strict risk control. Once I have positive expectancy systems, positive X, and I know what my financial goals are, and I know the frequency of trading, how many times I can trade over the time period, I want to trade at the lowest risk possible that still allows me to achieve my financial objectives with a high degree of confidence. Yeah, but what if my goal is to make as much money as I possibly can within reason? Well, then you have to say, what is the maximum that I can possibly trade this with rational justification? Then take 1/5 of that, and that's your actual position size for dollars at risk per trade. Whatever your optimistic, rational mind says is justified, start with 1/5 of that, and then go forward. Inadequate risk management. And this comes from the idea that no matter how well trained our AI is, no matter how good our back testing is, it is an incomplete sample of the entire market as it is, and it is an unknown sample of what the future market will be. And because I don't know what the future market will be, it is a leap of faith to say that it will comply with the patterns and rules of the past. That is a leap of faith that is unjustified. And that means that I should now approach this with the turkey problem, with humility. And I can use statistics to give me an edge because that is describing how all the other emotional market participants have behaved. But I need to be mindful of the fact that the world is changing all the time. And with more AI, it's changing faster than it ever has before. So you had better understand how to implement risk control and minimize the risk per trade, increase the number of trades, minimize the risk per trade in order to get the expectancy, and then study how expectancy changes over time so that you can learn to adapt to a changing market. And that's why you must invest in continuous improvement, which is continuous learning, and get away from emotional decision making. Be disciplined in your adaptation, commit to ongoing education, set achievable, realistic goals based on statistical descriptions of what's available, and then participate actively in a community of like minded traders where you can be an accountability partner to others and you can receive accountability partnership from others who are sharing their learning experiences and are speaking a common language that have a track record and a culture and a body of knowledge that will help you. That is the foundation of my approach to trading, education, and psychology. And based on that, now you can see why those top 10 would be what an AI says Dr. Ken Long says. And I just used AI and validated that. So I'm pretty satisfied that that's what I believe, because it is what I believe. And that's actually what's in the 350 pages of that foundational trading book. And more importantly, is in the Kata 2 challenge course and the swing trading course that those guys are teaching, and how to develop and adapt your own trading system, and how to use EdgeRater to give you robust signals that you can trade going forward. And I've talked a little bit about that already. Enough. Next question. Let's see. I've talked about common exiting, never more than 2% of portfolio risk per trade. But I really just use scaled risk per trade that I talked about before, which is sort of the on this one, the back test paper trade. Prototyping is $1 to $10. For me, limited production is $50 to $200. production is $400 a trade. That's the chip size that I use. I find that to be sufficient to give me a decision on how to put standard risk on standard patterns, whether it's in piloting, limited production or full rate production, or trading with markets money. Those are all correspond to chip size for me. And I make the decision based on performance and risk reward. Assessments of overall market conditions. I'm getting ready to go look at my weekend report, which has all of the things that I look at. I'm going to come back to that and do that last, because that's actually a look at the week ahead. How do I evaluate my trading results and the effectiveness of a system? Well, very specifically, for the last 30 years, this is how I've coached guys. Now, when we were going through our live trading Kansas City, we did a combination of swing trading and intraday trading, which with refinements looks very much like what we're doing today. And these are the only things that I even look at for each trade. This is a set of four days of trading. In those 4 days, I took in public on camera 88 trades. The best trade I got was 3R. The worst loss I took was -1R. I had 59 trades that were better than 0.3. I had 15 trades that lost more than 0.3. And I had 14 trades that were between plus or minus 0.3. These probably end up scratching. The micro losses balance the micro gains. So when I isolate the trades of significance, I had a 67% win rate, which averaged 0.97 wins. So I'm aiming for 2, and I averaged 1. And I had a win rate of 67%. And I had 17%, which is 1/6, and those lost on average 0.5. So my point flip was 3.5 to 1, and my payoff ratio was 2 to 1. I'll take that all day. I'd take that all week. When I took the average rolling R, it looked like this. So my expectancy was about 0.55. That was a pretty good 4-day rate. Oh, I know what my expectancy was. It was 0.56. And the standard deviation of production was 0.8. And that gave me, since I was so close to 100 trades, that gave me a system quality number of 6.5 for that week. And then this is my trade sequence plot. And you can see I had 3 trades that lost 1R, no losses worse than 1R. So that's the first thing that I look at. No losses worse than 1R. Between -1 and +2, a big fat normal looking distribution that is positive expectancy. That's the second thing. So I have a normal looking production run. And the third thing I look at is fat right tails. That is exactly the kind of performance that I'm looking for the kinds of systems that I create. If you're developing different kinds of systems, it may not look like this. If you're looking for long-term buy and hold trend following, like Michael Covell writes about in his beautiful book, you might get, according to him, a 25% win rate that averages 5 Rs and a 75% losing rate that loses 1 R. That's not going to give you this kind of a distribution, but it's a different kind of a system. So you better understand what your system is supposed to do and then have instruments that allow you to measure its performance. I can't tolerate a 25% win rate. I want that kind of win rate, and I want this kind of strict risk management. No super home runs hit here. I'm not looking for home runs. What I would like to have is a set of Kata 2s that look like, hey, maybe I got one on the SSC and then a half and then one. And over the course of the long life cycle, maybe it gets me 4R, but on 5 trades where I had very carefully calibrated risk and reward measurements all along the way. That's what I'm looking for. So you want to make sure that when you're asking that question, what is your basic process for evaluating trading results and the effectiveness? You have to realize that that rolls back into the system design and the results you're trying to achieve. Who are some influences and mentors? This is a subset of what we wrote about in the book. Deming for quality statistical process control, Tharp for psychology, Douglas for execution, Schwager to remind us just how many different strategies there are, but how each one of those market wizards had to go through existential pain and suffering. Steenbarger as a beautiful alternative to trading psychology, which is based on measurable data. I think Brashke, because so many people follow her work and LeBeau's work and Kaufman's work and Elder's work, each one of those guys have and gals have written about trading from a systematic perspective, have incorporated a lot of Van Tharp's work into position sizing and risk management, have offered a wide variety of successful systems. John Ehlers is particularly of interest because he is a very powerful advocate of systematic statistics-based trading and how to incorporate analysis of cycles and technical indicators, including how to build your own. Elder is very good on that as well. So I would say that's a pretty good list of the top 10, which I asked the AI to do. And I agree with 100% of that because that looks pretty close to the list that I wrote. The more expansive list is in the book Foundational Trading, which explores in greater detail each of the works of 30 different people who have influenced me and why I followed their work and where you can go to study more of their work. Which leads me back to, I think, the final question, which was number 7. What are some effective means of assessing overall market conditions? I'm just going to go to the weekend report and basically just show you the things that I look at each week to set up my swing trading and my day trading for the week ahead. And I just start with now there's on my homepage, the tortoisecapital.net, there's a more detailed elaboration of this. Let's see, I'm looking for Zoom. Stand by. I want to get I want to make it bigger. Sorry. There we go. All right. So what do I look at? In sequence, in the same sequence all the time. My market classification, I know that any bull plus sideways quiet is positive. That's why it's green to be long. Any sideways is no advantage. So I usually am not long or short overnight if it's here. And then any bull, that would be red, where on average tomorrow it's down. So I want to, if I'm going to have overnight exposure, I should be short. I then look at where we are on the 2-day, 10-day, 30-day, 90-day, and 207-day index. We're strongly overbought, and we have just slightly pulled back yesterday, but we're still above average. And I use those as generic traffic signals. I look at some additional measures of market condition, like price relative to the 200-day moving average. We're above it. We're 10% above it, but we've been better. What that means is that market is starting to stall, and the 200 period, which used to be far away, is getting closer and closer. So as this is getting smaller and smaller, we are now below average of the last 180 days on the distance between current price in the 200. So that means it's starting to stall as we go into the doji around this most decisive election in the past 100 years. So I look at that. I look at strength of trend using ADX. Right now, it's strong bullish. I look at the relative volatility, which is normal, using the ATR percentage of the last 14 days. That's why we're in normal for volatility, normal. The risk Z tells me that we just went through a period of increasing volatility, but it's starting to smooth out as we get closer to the election. This is a time to be ready for sharp moves in either direction when we're rising but below the zero line. I look at the ETF2 weekly exposure model on a weekly basis. 9 of the 10 large indexes of the world are above their 4-month moving average. So that tells me something about the world market model. These are the statistics that feed that table. I take a look at the 4 regression lines. The 10 is the trader's price. That's the blue line. That's price. I look at the black line, which is the 30-period regression line. That is the health of the trend, of the current trend, which is up, and it's above the 270 and the 90. That's good. This is as healthy as it can possibly be. The 270 is long and strong. That's the purple one. That is the health of the long-term buy and holders and what they think about. And they think America is the place to be, better than any other place. And then the 90 is the health, relative health of the longer term, which has had a little bit of a pullback because of election shenanigans, but is generally rising and to the right. So I use those 4 regression lines and their slopes to help me appreciate the 4 different demographics: day traders, short-term swing, long-term position, and then long-term buy and holders. So I think about market condition and classification based on their psychology. I use this to help me get a statistical view of where we are. I look at both 3-day and 9-day market bars so I can get a smoother look at longer term trends so I don't get overly fixated on shiny things on the 30-minute and daily bars. And this is what it says. The 3-day fast is we've had this leg 1, leg 2, leg 3. The time period of the legs is shorter. The movement is smaller, and we are dojiing up for the smallest 3-day doji since the last time when it had a break and then a big break. So this is the election coming, and we're going to get something like that. And so guys are hedging by reducing their exposure, trying to stay long on the things that they think are automatically going to be great, like NVIDIA. Why? Because they're so large, they're not going to go to zero, and everybody needs their chips for AI, and they are the future of that. And Palantir is also good because it's already above its previous long-term high. And what these guys do is sell specialized classified information to governments and large Fortune 50 corporations around the world. And everybody wants that, and they are the best in the business, and they get paid by governments and corporations who will never run out of money, and they are beyond the lockout period. When they went public, they did this, sold off hard to 12, and are now well above the previous levels. So they have no resistance above. And no matter who wins the election, they want Palantir's information. This is not an advocate to buy or sell. Do your own due diligence. Now, the guy that I'm not in is Tesla, except my long-term position. But because Tesla is going to explode to the upside if Trump wins or collapse tactically if Harris wins, because Harris is not going to protect Tesla against the EU, and they're going to try to tax the shit out of them to take all their money. So Tesla's looking at a tough road ahead if Harris wins, but all systems go if Trump wins. So if you were to take a look at Tesla, which, oh, we can, that's right. Yeah, we can do that. We're going to look at Tesla over the last, couple weeks. Oh, I thought I had that open. Sorry. While that's opening up, we're going to see that the 9-day, which is a longer term, leg one, leg two, panic, leg three is also terminating in the tightest little doji. So that's pretty important. So I look at that. I also look at the 150-day look back for the sniper. So the purple lines, the purple box is 150-day high, 150-day low, 30-day low, 30-day high, 10-day low, 5-day low, and then Friday's price action. So we are as sniper to the upside as you could possibly be. And we have a very clear set of downside targets consisting of Friday's low, the skin of the dragon and the PSAR, the belly of the dragon and the RL10, the 30-day simple moving average, the 30-day low, the lower hump of the dragon, the original PSAR flip, the 150 VWAP, the skin of the dragon, the skin of the RL10. So those are all targets to the downside, and there's unlimited upside if it goes up, because that was the previous peak, except for that, and it's all systems go until we find out who wins the election. Now, if I now have Tesla available to look at. So if I were to look at Tesla inside of this framework, let me look at my sniper set. If I zoom over to Tesla, that's Tesla on a 9-day. That's a lot of people waiting to see. That's what 9 days of wait and see looks like. Could be here, could be there. After the election, it's going to go there or there, I think. Here's the intermediate targets. Here's the short-term target. So when it breaks out of this range compression box, could it go that far in 9 days? It has before. It has again. Look how far it travels in 9 days. Could you find out what the average 9-day move is? Yeah. To address an earlier statement, if I just drill down to dailies, that's what perfectly hedging looks like. Guys that had this little run up from a buy on dip, leg one, leg two, leg three, hedging, current fair value 220. That's people that are not willing to take an overnight position. That's just machines trading back and forth between, and it's going to explode once we find out the election. Now that's different than NVIDIA, which is, I don't care who wins. NVIDIA is going to win. All-time high. What do you want for nothing? I mean, that's a 200-year time horizon to me. Palantir. Let's get to the night. That's the IPO and the sell-off. Everybody cashing out that owned it. And here's the long grind. It's so far above its previous, it doesn't matter. That thing is poised to sell information to whoever wins the election. That's a 1-2-3 entry on Friday. My initial swing basis on that is 22. Why? Because that's what Godzilla looks like. And there's a 1-2-3 entry and a PSAR flip. And now all of these are Kata 2s on the way up. But my initial basis in this is 22. Anyway, back to the report. You can see why market sector and target makes a difference in the strategies that you take. So here's my 150-day look back for the market. Here's my 30-day, or I'm sorry, that's 30-minute. Here's the 30-day look back on daily bars. Look how narrow Friday was. Nobody wanted overnight risk because everybody's worried about the next October surprise. And so they've already offloaded all of the positions that they are worried about at all. And look at the non-movement of the last 5 days. That's 30-minute bars in the red box. So in terms of trade location and reference points, this green line is your 3-day anchored VWAP. That's this green line right here. That's generally favorable and up. The red line is your 5-day anchored VWAP, which is pretty stable. We pretty much agree that 582 is fair value, wouldn't you say? There's your 5-day box. It went from the 5-day low to the 5-day high in one day. That's why I am an intraday trader on 30-minute bars. These are 30-minute bars. When it held support here and PSAR flipped, that was the easiest intraday trade I ever made. So the 5-day VWAP, anchored VWAP, the 3-day anchored VWAP. Here's your last 10 days. That's a reversion to the mean trade. If it fails below this dragon and then tests here and collapses, guess where we're heading to? The next level of support, which is either the dragon or the RL10 or the 30-day low at 568. And there is your 30-day anchored VWAP. So if this collapses, I can target this. If that collapses, I can add another position and go here. And if the 30-day low collapses, where does it go? Far, far away. Now, if I go back to the daily chart, there's my anchored 30, right? And this is my simple moving average 30. That's the Bollinger Band mean. Look how far away from the river we've stretched. So if this collapses, you're not allowed to be surprised if it comes all the way back to 568. And then if this fails, and then if this fails, here's your next support level at 550 and 545. That is the runaway panic freight train. That's why I keep track of all these little support levels on the way down, so that when I get to an extreme upside and it ends in a doji, if that fails, I'm a channel trader all the way back to here. That's just the last 30 days. From 585 to 565 to 540. That's minus 20, and that's minus 25. So that's almost 50 points on 585. That's only that's like about an 8% sell-off. That would be the beginning of people worried about a bear market. So that's why I'm a swing trader. Those of you who are listening for swing trade insights, that's why I'm a swing trader. And when you're a swing trader, but you also know how to trade intraday, some days you get a day like this, where it started at 550, went to 540, which was a 2% sell off, and then made a 4% sell buy to come all the way to almost 560. You had almost 8% of travel distance inside a single day. That was except for this day, which was just open and collapse. Those were the two best trading days in a row. And the reason that I pay attention to recent volatility is that large volatility in one direction can lead to large volatility in the next direction, and leg one can lead to leg two and can lead to leg three. Notice that as that starts to decay, you not surprised by this, but failure to fail now leads to that. So just looking at the last 30 days is probably all the market classification you might need as a swing trader. Just saying. And if you were focused more on intraday, you might only need to go back 10 days with 30-minute charts. So I got a workshop on that that looked at 2 full years of daily swing trading on 30-minute bars for 30 symbols. That has 6,000 case studies in it. Griff, looking at you. We got work to do there, buddy. I also look at the blended monthly rebalancing, the ETF 13, 22, and 32, 33, excuse me. And so I just look at here's in the blended monthly rebalancing, we blend the 3 month and the 6 month to give us this blend, and then we organize it by that. And we look for exceptional outperformance, above average performance. Here's the mean, below average performance, and then horrible underperformance. So that gives you insights into long-term buy and hold success. Right now, it's China, utilities, silver, and real estate. Those are all the defensive plays, my friends. What's horrible? Energy, globals, treasuries getting murdered, Europe. If it's interesting to look at those, I can actually front run that and gain more insights by looking at the last week and the last month and using the same 4 category color coding to let me know how we're doing. I also can look at the 4 month moving average and simply make the buy it or cash on the basis of the 4 month moving average. That's what the blended monthly rebalancing does. So I use that as this is not only actionable, it also provides important, useful information. I do the same thing looking at the symbols in the Dow. I am always interested, like a catfish. Who's the worst? Intel's down 3% and is just getting slaughtered. Hey, does Intel make semiconductors? Yeah. Are we going to let them go to zero? No. Are they going to get government money to return semiconductor manufacturing to America? Yes. Are they at a moment of advantage? Yes. Am I in a hurry to buy them? No. Could there be a long way back to the top for Intel? Yes. What would that look like if I use my standard framing? Well, how about if I just look at it this way on a daily bar? Is that everything you need to know? Yes. If I put the sniper structure on it, there he is. There's the long-term fair value of the 150-day anchored VWAP. That's about from this moment here, when price was at the long-term fair value, it sold off to this level from, call it 38 to 19. That's minus 50%. And now has it stabilized? Yeah, there's the first buying surge. Pause, pause. And now it's in a little doji. I'm ready to say, Yeah, I could see it getting back to normal. But if it fails, I have some targets to the downside, and it's in the semiconductor space. So I can actually start looking at this rascal on 10-minute bars and start framing some trades. There was a pretty nice trade on the 16th when it went from 22.70 to 21.50. That's over a 10% sell off that morning, followed by an 8% bounce the same day. Why do I like looking at the 10-minute charts? Because I can intraday trade that one pretty easily. Is it on my short-term list of always ready to trade it? It sure is. This was that was actually a yeah, there's a one day in Intel right there from, it had settled into a sell-off position. It opened with a gap down. There's my opening range 10. There's a standard short. There's a 1, 2, 3 exit to make bank. There's a PSAR flip. There's a standard trade from 22 to 22.40 on about a 10-cent risk. That's a 4-hour trade intraday, the lowest risk trade that you ever saw. And because it was set up on a swing trade basis, I can bring that information intraday to trade. Yeah, and it was a 5DD earlier, as Griff points out. So why do I look at all of the Dow? And it's the modified Dow, because I have a few things in there that are of interest. But I just like to know who's at the top of the list and who's at the bottom of the list. I'm interested in healthcare because they just got slaughtered worse than anything this week. That might be a buy on dip or a lead to further collapse. Walgreens up 17% this week. I bet you that's not going to last. I bet you there's something interesting. And the same thing with Travelers. Holy smokes. Finance. Is that anticipating something in the election? I don't know, but we're going to go look at them. So I can use other trading systems that are swing in order to set up not just swing, but also day trading. I can look at the entire robust set of ETFs. Oops, I can look at intraday trading. Anyway, the rest of the daily and weekend report is there. I've sort of made the point I wanted to make. Effective measurements for assessing overall market conditions. I think I've shown you a reasonable set of how those are actionable. So I want to turn it back over to you for any final questions before we get this produced. Yeah, the main thing when I'm looking at trade location as a sniper is it when I'm looking at 10-day, 30-day, and 150-day lookup, is it oversold? I mean, overbought, oversold, or smack dab in the middle on 3 different time frames, because each one of these time frames represents a different demographic that pays attention to their own work. But if all 3 of them are in a critical state and they all start acting simultaneously as they break out of a doji, then they surprise each other because they were only expecting their guys to be activated. They weren't ready for these other things. And then I care about abnormally large or abnormally small volatility, because from the extremes come extreme results. And that's validated by some work that Phil has recently done by taking a look at 5-day volatility and 1-day volatility. So that is the most robust set of edges that I can possibly imagine. Regardless of what machine learning does for AI, it's all going to be expressed through location and volatility. And that's why you need to understand sniper trading, and you want to use EdgeRaider or my work to give you the setups plus the the swing patterns, and you want to use the Kata 2 and the Kata Challenge to simplify, standardize, and industrialize the way you take advantage of any signal, whether it's a fireworks or a Godzilla or it's a 5DD or whatever. All of these things converge towards Kata trading and the use of statistics for standardized risk management. That's what you got to do. That's my summary of the work for today. Any final questions before we thank you for your kind attendance? If there are, just send them to Griff and Phil, and we'll do these once a month, and I'm happy to provide that. All right. Have a good rest of your Sunday. Let's go Chiefs. Beat the hated 49ers. And I got to head over to the soccer field in here in about 10 minutes to go play soccer with some kids. All right. Thanks so much for your attention, guys. We'll get this published and posted and back to you. And I'm gonna stop the recording, and Phil and Griff, I'll give you any